Assalamu alaikum and good morning. Welcome to Cambridge Islamic Finance Access Program, which previously was known as Cambridge Islamic Finance Structuring Master. We have renamed it as the Cambridge Islamic Finance Access Program to differentiate it from our Medina program, which is called Cambridge Islamic Finance Structuring Master Medina program. Cambridge IFAP is being offered for the fifth time. This is season five. Previously, we have delivered four seasons in the name of Cambridge Islamic Finance Structuring Master. These modules, they are part of this 10 module series, as I mentioned, called Cambridge IFAP. And we have delivered a couple of sessions already in this season. And today's session number 3, is third of the 10 modules we shall be delivering as part of the Cambridge Islamic Finance Access Program Season 5. The title of today's session is Structuring Islamic Investment Products. And before that, we have delivered two sessions. Session number 1 was on the art of structuring Islamic financial products. Session number 2 was on developing innovative Islamic retail banking products. And this session is on structuring Islamic investment products. So we started with a general one, giving an introduction to how innovative Islamic financial products can be structured for the benefit of individual Islamic financial institutions and, of course, for the Islamic finance industry as a whole. The second session was specifically on the Islamic retail banking products. And there we used a couple of examples of some kind of innovation in Islamic retail banking. Today, we would be looking into Islamic investment products, and hopefully, we would discuss a couple of examples of possible innovations in Islamic investment products. And after this, we shall be delivering another 7 sessions on different aspects of Islamic banking and finance. As always, we start with the learning objectives. The learning objective number 1 of this session is to introduce the participants to popular Islamic investment products and their structures, highlighting Sharia issues in the process. We make sure that we do not go into the details of basics of Islamic contracts. However, there is always some kind of necessity of sometimes explaining some basic concepts, but this should not be an expectation of the participants. So, learning objective number 1 is to introduce the participants to popular Islamic investment products without going into technical details of the products which have already been offered in the market. We would be focusing on certain things which are relevant to think innovatively. So, popular Islamic investment products, not all of them, but some of them we would be referring to when we say the Islamic investment products already known. We refer to Islamic investment funds, Islamic structured products, and Islamic alternative investments. And in this whole process, Sharia is very important. Hence, we would be highlighting some Sharia issues in the process as well. Learning objective number 2 is to highlight the importance of developing cutting-edge Islamic investment products to improve depth and width of Islamic finance. This is very important. Islamic retail banks or high street Islamic banks tend to offer some very plain vanilla banking products. And a lot of people think that these products are more or less the same as conventional products, at least in terms of their economic profile, and hence they think that there is nothing distinctly Islamic about Islamic banking and finance, which is not the case. in the background, a lot of things happen which are distinctly Islamic. And for those practices to remain distinctly Islamic, it is important for the industry to continue to come up with innovative Islamic products which should help the industry to grow and, of course, for the industry to deepen as well. Learning objective number three is to incite the participants to start thinking innovatively to develop financial products which have a distinct economic value proposition vis-a-vis conventional and existing Islamic financial products. And this is an objective which would run throughout this season. This was learning objective number three for session one, for session two, and you must have noticed that this is actually the learning objective number three for this session as well. And this highlights the fact that our major focus in these 10 modules is to incite you to come up with the innovative Islamic financial products, or at least start thinking innovatively when it comes to product development in Islamic banking and finance. So these are three learning objectives. As always, we would have three learning outcomes. Learning outcome number one is our expectation for you to have developed good understanding of the existing Islamic investment products and the major relevant Sharia issues. Also, by the end of this session, and after you have gone through some relevant material voluntarily in your own time, the participants must also develop a fair understanding of the relevance of new trends in Islamic investment practices for further developing Islamic banking and finance. The third learning outcome is the same as for the previous two sessions. You are expected at least to start appreciating the need for reforming the existing practices and products offered by Islamic financial institutions. So these are three learning outcomes which correspond to the three learning objectives. So after this introduction, let us go directly into Islamic investment sphere or Islamic investment field, and we look at some of the incumbent Islamic investment products. When we refer to Islamic investment products, many of you would have reference to Islamic investment funds in their minds. So this is an obvious example of an Islamic investment product. Although many of you might think about profit sharing investment accounts, which are offered by Islamic retail banks or Islamic high street banks as part of their retail franchise. So I would not refer to that one because we have already discussed, or at least we have referred to, profit sharing investment accounts in our previous session. So Islamic investment funds, this is one product which comes to our mind when we are referring to Islamic investment products. Islamic structured products, this is another area which is relevant to Islamic investments. A lot of Islamic high street banks and Islamic investment banks, or the banks offering Islamic investment solutions, they would have a variety of Islamic structured products to meet the demands of their respective clients and customers. Islamic alternative investment products, these are a third example of the existing Islamic investment products. So Islamic investment funds, Islamic structured products, Islamic alternative investment products. In alternative Islamic investment products, we have reference to real estate funds or real estate related investment products. In some cases, we had reference to Islamic hedge funds. About 15 years back, there was a lot of emphasis on creating Islamic hedge funds as alternative investment vehicles available to those who are interested in Islamic banking and finance and are looking for this kind of sophisticated solutions. Islamic private equity funds, this is another example of alternative investment products offered in a Sharia compliant way. And of course, we cannot forget sukuk. Sukuk is an example of Islamic investment products as well. We would not be referring to sukuk in this session because the next session is dedicated to sukuk. So hopefully next month when we have session number 4, we would focus on sukuk, and I would request you to be patient until then when we go through some innovative sukuk structures. Let us focus on Islamic equity funds as part of Islamic investment funds. Sometimes we call Islamic equity funds as Islamic investment funds as well, but this is a subcategory under Islamic investment funds. So Islamic equity funds is one subcategory. Islamic private equity fund could be another one. Islamic hedge funds, if they are in existence, this could be another example of Islamic investment funds as well. So Islamic equity funds, if we look at them closely, the basic objective is to invest in listed stocks in a Sharia compliant way to benefit the shareholders or benefit the investors in these stocks in a systematic manner. Investment in listed stocks was not unanimously or universally accepted before the 1990s. In the 1980s, there was no consensus amongst the contemporary jurists whether investing in listed stocks was Sharia compliant or not, because a general perception of the stock markets was that these are places where people speculate on the prices of the listed stocks, and hence this could be something akin to gambling. A lot of Sharia scholars, they took a conservative approach when people sought their advice whether this was Sharia compliant to invest in these stocks or not. However, in the 1990s, especially towards the end of the 1990s, Dow Jones, FTSE, and some other index providers, they developed Sharia screening methodologies which allowed Islamic investors to have exposure to equity as an investment class. So investment in listed stocks, this is actually the major focus of Islamic equity funds. When we look at the stock markets around the world, including Islamic countries or the countries with Muslim majority, we find that not all the listed stocks are Sharia compliant, i.e., not all the companies which have listed their stocks on the stock exchanges, they are completely Sharia compliant. In some cases, they are blatantly Sharia repugnant. For example, if a conventional bank involved in interest-based activities is listed on a stock exchange as well, it is not permissible to invest in the listed stock of that bank because the primary activity of that institution, that bank, is Sharia repugnant or impermissible. Hence, the listed companies must be involved in permissible activities if someone wants to invest in listed stocks of the companies and is looking for Sharia compliant solutions. Given that on stock exchanges there are companies which are involved in completely impermissible activities, and there are companies which are involved in permissible or halal activities, and a very significant proportion in between is involved in some kind of mixed activities. By mixed activities, I mean some of the activities may be Sharia compliant and some of the activities may not be Sharia compliant. So identification of such companies is important from a Sharia viewpoint. And unfortunately, this is not a simple case. A lot of people think that identification should be easy. I gave the example of a conventional bank. If a bank is involved in interest-based activities, that bank is not a candidate for investments from the Sharia sensitive investors. But this is not that simple, and we would be using one example to highlight. However, as I said, there are now very well known Sharia screening methodologies which have allowed us to identify the stocks which are Sharia compliant and, of course, segregate them from the non Sharia stocks. Let us take the example of Apple, and I'm not referring to the Apple which we eat, but rather the company which produces iPhones, iMacs, MacBooks, etc. And all of us, we are aware of Apple. Now, Apple is a listed company, i.e., it has a listed stock. And the question arises whether this is a company which could be categorized as Sharia compliant. So, is it a company involved in Sharia compliant activities? On the surface of this one may say that yes, this is a company which is producing hardware, i.e., computers, other machines, accessories, etc. Hence, this should be a Sharia compliant company and its stock should be Sharia compliant. However, as I mentioned, this may not very well be the case because hardware is not the only thing which Apple produces. There are quite a few other activities in which Apple is involved, and I'm sure you are aware of those activities. So, iPhones, iPads, MacBooks, etc. These hardware products, of course, they are Sharia compliant, and we would not have to go into a lot of details to determine whether they are Sharia compliant or not. Having said that, there is now an extension, and this is an innovation. This is an innovative part of Islamic investments. A lot of young Sharia scholars, they have started emphasizing upon looking into the practices and procedures involved in the production process. For example, some young Sharia scholars, they say that if a product, say an iPhone, has been produced in a jurisdiction where labor laws are not very tight and hence child labor or some kind of coercion in the labor market is observed, and they say that because this is against maqasidu Sharia, the objectives of Sharia, this kind of activities should be considered when we are proclaiming a product to be Sharia compliant. As of now, there is no huge emphasis on this one, although the emphasis on ESG is increasing. But the Sharia screening methodologies, by and large, they do not take into account this aspect of production process. So, for simplicity, we would say that when it comes to hardware products, Apple is a Sharia compliant company, or it is involved in Sharia compliant activities. But hardware is not the only thing in which Apple is involved. Apple offers iTunes, Apple TV, Apple Card, and there are so many other services which are being offered by Apple. So there are products and then there are services. And we are not quite sure, or at least the Sharia scholars, many of them would say that they would not be certain whether these activities are fully Sharia compliant. Primarily because in the accounting and financial disclosures required by the regulators, the detailed financial information about these services is not available, and hence we have to come up with a guess. Let us look into Apple in some great detail to find out whether Apple is a Sharia compliant stock or not. For quite a few years, we have advised our clients that Apple was a Sharia compliant stock. However, last year and even at the start of this year, we advised some of the fund managers who are our clients that Apple is not Sharia compliant. So, from our side, from Cambridge IIF, a couple of companies which wanted to have Apple in their portfolio, we advised them against it. However, this may not be a very simple case. You would find, if you have interest in Islamic equity funds, there are some very well known Islamic equity funds which have Apple in their portfolio. So we would look and we would ask you to make your own judgment whether this is a Sharia compliant stock or not. To determine whether Apple's overall business is Sharia compliant or not, we look into its revenue. Now, its revenue comes from the sale of hardware products, and the other part of the revenue comes from services like iTunes and other services. In the last financial reporting of Apple, their 10K filing with SEC in the United States of America. These were two figures they mentioned under their revenue or sales. Hardware produced 66.6 billion US dollars in revenue, i.e., sale of iPhones, MacBook, and accessories, etc. All these products we are aware of. Services contributed 27.4 billion US dollars to the revenue of Apple. Now, services, this is a very significant number, 27.4 billion. And as I mentioned earlier, we are not sure, 100% sure that all these services are Sharia compliant. So total revenue of about 94 billion. This was as per the last 10K statement of Apple, which was submitted to SEC. So 94 billion, roughly, this was the total revenue, out of which 27.4 billion came from services. This is a very significant proportion of the total revenue. 29.16. So roughly say about 30%. So 30% of the revenue of Apple comes from services, and the remaining 70%, still majority, comes from the sale of the hardware. The 29.16, this is a very large figure, as if you know that we have a threshold for Sharia compliancy of the stocks when it comes to the nature of business. The Sharia standard is if a company has got up to 5% impermissible income, up to 5% impermissible income as percentage of the total income or revenue. We will not go into the accounting detail. Some analysts, they use revenues, others they use sales, etc. So I would not in these 90 minutes be boring you with those details. But as a kind of simple rule, if more than 5% revenue of a company comes from impermissible activities, that company or its stock would not be deemed Sharia compliant. Now, in case of Apple, about 30%, 29.16% of its revenue comes from activities about which we are not 100% sure. Now, we have to take a kind of judgment here. iTunes, for example, iTunes has a lot of music on it, but it has some books and so many other products which are actually okay from Sharia viewpoint. But music, entertainment, that kind of things, Sharia takes a different view. Similarly, when it comes to the Apple TV, because it facilitates entertainment, the view is that the revenue coming from Apple TV would not be deemed as Sharia compliant. So one view is that we would divide the revenue coming from services by 4 and then come up with a figure of impermissible revenue as percentage of the total revenue. When we do so, then the figure we receive is 7.29%, which is still higher than the 5% threshold. So this is why I said this is up to you whether you still think that this is a Sharia repugnant stock or Sharia compliant stock. We, as I mentioned previously, we have advised at the start of this year that the Islamic investment funds, Islamic equity funds, should refrain from investing in Apple because of this ambiguity about the nature of its revenue. However, there are some investment or fund managers which have taken a different view, and hence they have included Apple in their portfolios. But the question after this conversation, the question to you is, do you think that Apple is a Sharia compliant stock? Revenue is only one aspect of the Sharia screening methodologies. We have to look into some other financial screens as well. For example, debt equity ratio. This is an important consideration when the stocks are screened from Sharia viewpoint. So in the same financial reporting, we found out that total debt, short-term and long-term, of Apple was 91,775 million. So about 91.7 billion. And this was a 3 monthly quarterly revenue. And this is the latest figure I could get hold of for the purpose of sharing this information with you. So 3 months ending June 2025, total debt of Apple was 91,775 million. And this was mentioned as reported on June the 29th, 2025. So this is the latest figure which we can rely upon. Market capitalization, debt equity ratio we have to calculate. So market capitalization 3 months ending June 2025 and as reported on June the 28th to 25, primarily because 29th was the holiday, there was no trading. So we are taking this date, which is very close to June the 29th. That was 3 trillion US dollars. That is the market capitalization of Apple. So when we try to calculate debt equity ratio, so that is 3.06%, which means the impermissible interest based debt of Apple divided by its market cap, that is 3.06%, which is far below the threshold. And we would come to this in a minute. So cash plus interest bearing securities divided by market cap. This is another consideration we take when it comes to screening of the listed stocks. On June the 29th, this was 55.3 billion US dollars. Market cap, as I mentioned, this was 3 trillion. So when we calculate liquidity ratio based on cash plus interest bearing securities divided by market cap, then this is 1.85%. Again, this is very low as compared to the threshold. The third financial screen we look into is the receivables. So receivables on June the 29th were reported to be 27.5 billion US dollars, and the market capitalization remains 3 trillion. So receivables ratio was 0.92%. So we looked into the impermissible revenue screen and then the three financial screens, and that gives us liquidity ratio of 1.85%, debt equity ratio of 3.06%, and receivables ratio of 0.92%. And as I mentioned, okay, these three ratios, they're far below the threshold which is determined by the Sharia standards, which is 33.33% for the first one, liquidity ratio, 33.33% for debt equity ratio, and for receivables as a percentage of market cap, the requirement is that they should be less than 50%. So all these three ratios, they are within the threshold. And when we combine this with income ratio, as per our calculations, with our assumptions, that was 7.29%, which is higher than the 5% threshold. Now, the question is with you, whether you would like to deem this as a Sharia compliant stock or not. So when it comes to the first three ratios, yes, compliant. When it comes to income ratio, this is not compliant as per our calculations. As a Sharia advisor to Islamic equity funds, I personally do not feel comfortable using market capitalization as a denominator, because this is too liberal an approach. I gave example of Apple, but you take all other big companies. When it comes to big companies, companies with huge market cap, it is very likely that all of them, they would be Sharia compliant when it comes to the three ratios: liquidity ratio, debt equity ratio, and receivables. And we will find that, they are like this one: 1.85, 10%, 11%, 15%, that kind of ratios, which are very much within the 33% threshold. Instead of market cap, when we use total assets as the denominator, like debt divided by total assets. And total assets, this is a figure which is readily available, and this is a stable kind of figure. This is reported on a quarterly basis, 6 monthly basis, and 9 monthly basis, and of course, not 9 monthly. Yeah, there are quarterly, and then okay, the companies, they would report this for the 9 months as well. It doesn't matter whether this is quarterly or a 6 month figure or 3 months figure or 1 year, because this is actually a stock concept as of now, the snapshot of total assets. So this doesn't change. So when we use total assets as denominator, we find that liquidity ratio is 27.69%, which is very close to, it's still lower, but very close to 33.33% threshold. Debt equity ratio, that is 16.70%. Receivables divided by total assets, that's 8.31%. And of course, income ratio doesn't use assets anyway. Still, this is actually compliant. But given that these figures have got inflated, they look more realistic in my viewpoint. So those who are looking for coming up with the better, from Sharia viewpoint, better Islamic equity funds, they should be using total assets as denominator rather than market cap as the denominator. Now, market cap, we say that, market cap as of now, as of 29th of June or as of 21st of October. But in practice, the fund managers do not use that daily figure, but rather if the markets are behaving well, they would say 12 months trailing average market cap. So 12 months are taken into account. When the markets become very jittery, the fund managers request Sharia scholars, allowing them to use even 36 months trailing average market cap. So if we are using this history of 1 year, 2 years, 3 years, and in some cases 5 years, a better approach is to use total assets as a denominator, which is a very stable figure. So compliant, compliant, compliant on the basis of first three ratios, non-compliant when it comes to the income ratio. This is question for you. Given this analysis of Apple, you still think this is Sharia compliant? If you say yes, this is Sharia compliant, I would not have an objection to that one, because HSBC's Global Equity Index Fund actually has Apple in its portfolio. Another very well-known Islamic investment company called Wahid Invest, they, in their portfolio, they have Apple as well. Hence, these companies, they have taken a view that Apple is still a Sharia compliant stock. However, on the revenue side, there is some kind of ambiguity. Now, the question is, when you are thinking of setting up an equity fund, what are the steps? Identify a Sharia universe of stocks. This is your first step. Build a portfolio of Sharia compliant stocks. This is step number 2. Major step I'm talking about. Agree on a Sharia governance framework. This is very important. If you have chosen debt equity, i.e., if you have chosen a Sharia screening methodology which uses market cap as a denominator, and down the road you start using total assets without properly reporting, this would be a breach of Sharia protocol. So you must agree on a Sharia governance framework, which one you are going to use, Once you have decided to use a Sharia screening methodology, then you should stick to that one. All rules and regulations of a particular jurisdiction will apply. If you have decided to domicile your fund in Luxembourg, the Luxembourg authorities, they're very well aware of Islamic requirements. They would ask you to do a lot of things to ensure that whatever you are offering in the name of an Islamic equity fund, this actually remains Islamic. So it's very, very important that you follow the rules and regulations of the jurisdiction in which you have decided to domicile your product. So this was an example of an Islamic equity fund. Very simple, I would say, process. You choose a relevant Sharia screening methodology, identify a Sharia universe of stocks. And when I say identify a Sharia universe of stocks, you don't have to do all the things in-house. There are now Sharia screening companies, and many of them, they have their apps as well. For example, there is one called Zoya. You go to Apple Store, you can download it. And of course, these are not free services. You have to pay for these services. So you identify a Sharia universe of stocks, you build a portfolio, agree on a Sharia governance framework. In most cases, you will have to install a Sharia board, and the regulatory requirements of the jurisdictions must be observed. So this is not very difficult kind of thing to set up an Islamic equity fund. The second example which I wanted to use was that of an Islamic structured product. And this is an example which I have constructed to give you some food for thought. So let us look into HSBC's Islamic Global Equity Index ICGBP. Okay, this is a fund which is in GBP, British pounds denominated. This is live data for that one. Okay. So 5 years trend, total returns on 1,000 pounds. So if someone had invested 1,000 pounds in July or June 2020, they would have got this much return in 5 years. So if you choose 5 years, you will get this one. If you choose 3 years, 1 year, 6 months, 3 months. So for the illustration purposes, I just use this 5 years. Investing in this fund would give you certain pattern of returns. An investor is happy with this product. However, the investor wants to have exposure to this fund with the capital protection. This is an interesting thing. All these equity funds, they would not give you capital protection. In fact, okay, they would say that now you are investing your 1,000 pounds. 1,000 pounds, this is only for illustration. Otherwise, the minimum requirement for investment is, I think, 1 million in this fund. They would say that, the value of your money can go up or go down depending on the performance of the portfolio. An investor who is a Sharia compliant investor wants to have exposure to this fund with capital protection, and there comes the role of structured products. If we can structure an Islamic structured products which offer exposure to something like this fund, but at the same time offers capital protection as well. Many of you might think that, oh, capital protection, this is not in compliance with Sharia. This is a myth. No. If someone is looking for a floor, someone is looking for protection for the capital, and if this can be done in a Sharia compliant, why not? And we would see how we can do this thing. Now, basically, the investor says that, I would like to have exposure to this fund in such a way that I have this floor, i.e., my return doesn't go below this red line. In this 5 years horizon, you would say that it's not going down the red line anyway. So what's the point? But this is, as I said, this is a 5 years data. When you look at, say, 1 year data, total returns on 1,000 GBP, then these lines, they are different. So this, say, between March and June, the performance was below the capital protection, i.e., the portfolio performed in such a way that the investors were in actual loss in that period. And even when you look into the 3 months and 6 months, okay, there is a lot of variation. So if someone is looking for exposure to HSBC Islamic Global Equity Index with capital protection, this is not something nonsense. This makes a lot of sense for them. How to structure this product? This is something you should be paying attention, because this is a very valuable kind of expertise. If you understand how to do this one, then you can come up with a lot of innovative Islamic investment products. So this investor is interested in capital protection. The step number one, there will be note issuer. Someone, even HSBC itself, can issue a note, structured note, or another investment house can issue a note on HSBC Islamic Global Equity Index. That structured note would be sold to the investor for 1 million. That structured note would be structured around investment agency and a master murabha agreement. So basically, investor would appoint through the structured note the note issuer as its investment agent. And of course, this would have another arrangement which would be governed by a master murabha agreement, pursuant to which the investor and note issuer may enter into a series of commodity trades. And we would go into the details of this in a while. I'm simplifying the things for you to understand. So for someone who is looking for capital protection for an investment which otherwise is volatile, a note issuer issues a note, which is a Sharia compliant note, which is based on investment agency, and this has another aspect called master murabha agreement. And there is another one as well. I would introduce that one when the time comes. So basically, this structured note says we would ensure that your return doesn't go below this one, i.e., this is 1,000. You enjoy capital protection. However, because we are offering you this capital protection, when the return is above 1,500, then this performance that would be kept by us as a compensation for offering you this capital protection. This would be in the term sheet of that note. So a structured note is issued which has a face value of 1,000. This is based on investment agency, and there is a master murabha agreement. After receiving £1 million from the investor, the note issuer actually invests that money with HSBC Islamic Global Equity Index. And pursuant to this note, the investor will receive performance of HSBC Islamic Global Equity Index with floor of capital protection and ceiling of 10% annual return. So basically, this says that as long as the performance of this fund remains within this 10% return bracket, you would enjoy that performance. However, if the portfolio performs really well, then the return beyond 10% annual would be kept by us. This is the nature of this structured note. So this is issued on, say, today's date, and both the investor and the note issuer, they don't know what is going to happen in the next 5 years. So this is a 5 years structured note. We know the performance, the previous one, this one, we know this is the history. However, when the note is issued, then we don't know. Both the investor and the note issuer, they don't know. Now, if price per share was £20 today, I checked this is 19 point something. But for simplicity, I'm saying if today the price is £20 per share and the note issuer buys 50,000 shares into this HSBC Islamic Global Equity Index, this is what happens. So 50,000 shares of this Global Equity Index fund are bought by the note issuer. Now, if the portfolio behaves like this one over the next 5 years, we saw the historical performance. This is the future performance. If when we reach October 6th, 2030, the portfolio has behaved like this one, then what would happen? This was the band, these red lines. the performance has been beyond that one. So in that case, on October the 6th, 2030, the investment of 1 million will have a value of 3 million, roughly 3 million 1,500. The note issuer will use 2 million out of 3 million to buy a commodity X from a broker. This is all written in the term sheet of the note. So this note issuer will buy a commodity X from a broker using 2,000 out of 3,000. The note issuer will then sell this commodity X to the investor for 500,000. This is this master murabaha agreement. I referred to that one. Pursuant to that one, these transactions would take place. Buying something for 2 million and selling it for 500. The investor will then sell this commodity X to another commodity broker for 2 million and would get a return which would be equivalent to 10% annual. So the objective has been achieved. Okay. Well, there is capital protection. And of course, 10% performance. This has been achieved by the investor. And whatever was beyond that one, that was kept by the note issuer. Now, this arrangement, which I have mentioned, purchase and sale of commodities between the broker and the note issuer and then the investor, this is essentially a commodity murabha arrangement, and this would be as per the master murabha agreement. This is why I mentioned in addition to investment agency, there would be master murabha agreement. Now, if the performance of the portfolio over the next 5 years was like this one, on October the 6th, this is between this band. Hence, at that point in time, on October the 6th, 2030, the investment of 1,000 will have a value of 1,171,500. The note issuer will pass on this amount, net of any fees, to the investor. So in that case, the investor would receive the performance of the HSBC Islamic Global Equity Index with this peace of mind of capital protection over the 5 years. So this is the two scenarios combined. So when on October the 6th, this is the situation, then action pursuant to master murabha agreement would take place, i.e. the commodity trades would take place. If it happens to be the case that the performance is within this band, no action pursuant to master murabha agreement would be taken, i.e. no commodity trades, no nothing would take place. So this is the two scenarios. If we have the third scenario, this red line, when the performance is below the capital protection point, then what would happen? Again, an action pursuant to master murabha agreement would take place, and this would be then the case. And then on October the 6th, 2030, the investment of 1 million will have a value of only 875,500. The note issuer will top up this amount with 174,500 from its own pocket and buy a commodity X for 1,050,000. The note issuer will then sell this commodity X to the investor for 50,000. The investor will then sell this commodity X to another broker for 1,050,000. And the end result would be the investor will get its 1 million back, i.e. receiving full capital protection. So this is how a capital protection note, Sharia compliant structured note would be structured and issued. You can have this kind of diagrams for all the two cases. The case when the performance is very high and when the performance is very low, lower than the capital protection. So this is what happens. This is the value of the portfolio on October the 6th, and the note issuer then top up this money with this amount and buys this commodity X from the commodity broker 1 and sells this commodity to the investor for 50,000. Okay, so receiving 50,000 here, then investor sells this commodity for 1,050,000 to commodity broker 2, and the end result is capital protection, as I mentioned. So these are the steps. Step number 1, the note issuer receiving the performance of HSBC, IG, EI, IC, GBP, topping up the amount and buying a commodity, selling that commodity to the investor, and the investor selling that commodity to a commodity broker. The end result is that the investor receives full capital protection. Let's focus on the first case again, when the performance was very high. Now, what happens in this case? The first case, when the performance was such that the 1 million became 3 million. So note issuer would receive 3 million from HSBC fund, will use 2 million out of this one to buy this commodity, and before doing that, of course, this will keep this much money with it, 1,001,500, and will sell this commodity which it has bought from commodity broker for 1,501,500, and the commodity broker, then investor would sell this for 2 million to the commodity broker, and this would be 10% annualized return for the investor. So this is basically a summary of this one. When HSBC fund generates a return above that of the promised in note, the note issuer earns a profit in addition to the management fee. So this is the note issuer is in net benefit. The investor earns the return up to the threshold level, 10% in this example, 10% annualized return. When the fund generates a return within the brand promised in note, the note issuer receives just the management fee, and the investor receives the full performance of the HSBC fund. When HSBC fund generates a loss, the note issuer bears loss and receives management fee. The net benefit loss to the note issuer is determined by the performance of HSBC fund. The investor enjoys the capital protection. So this is one example of an Islamic structured note. This kind of structured notes are very frequently being used by Islamic banks for their treasury management operations. So this is very important to understand that these are not retail banking products. A lot of people get confused. They say if you are issuing this kind of notes offering full capital protection, then what is the difference between this one and an interest-based arrangement? From Sharia viewpoint, this is not akin to the interest-based loans. Interest-based loans are very simple products. You give 1 million and you are guaranteed a return of 3%, 4%, 5% with full capital protection. In this case, there is a lot more going on in the case of the product. So this is not interest related kind of product. There is no interest involved in this case anyway. This is the performance of HSBC Islamic Global Equity Index, which is a Sharia compliant product that is given to an investor with an added advantage of offering capital protection. As I mentioned, this is actually offered to the Islamic banks by big investment banks. When I used to work for Deutsche Bank, we sold quite a lot of this kind of structured notes to Islamic banks around the world. And now many Islamic banks, they have started structuring their own structured notes for their business clients. So a lot of big businesses, Etihad Airlines, for example. So Etihad Airlines, if they want to use Islamic products for their treasury management operations, they can buy this kind of structured notes offered by Abu Dhabi Islamic Bank, ADIB, or Dubai Islamic Bank, or any other bank which is offering this kind of structured notes or structured products. Now, important thing which I wanted to highlight was it's not just investment agency and master murabha agreement. For this structured note to work in a binding way, there must be this third arrangement, promise to purchase given by investor and promise to sell given by note issuer. All these are part of this term sheet. This structured note would say that pursuant to this structured note, investor hereby appoints the note issuer as its investment agent. Then they have another document. This is a master murabha agreement pursuant to which, as and when there is a requirement, investor and note issuer would enter into commodity trades as per the details given. And the third thing, which is absolutely important for the functioning of this structured note, is a couple of promissory notes. which would be part of the product. Promise to purchase given by investor and promise to sell given by note issuer. We looked into promises in our last session, and in this session, we are giving another example from the investment products. So this promise to purchase and promise to sell, this is very important. And this is a simple, this could be a two-pager. Okay? In some cases, even one-pager. And the crux or the main theme of this promise to purchase is this thing, which is on the screen. And you should take a note of that one. So basically, in this case, promise to purchase given by investor. Investor says and signs on that one. I promise to purchase an amount of commodity X from note issuer, and of course, the name of note issuer would be there. This could be JP Morgan. So I, for example, me as an investor, I promise to purchase a commodity X, and that commodity's name would be the aluminum, for example, from JP Morgan on date, and that date would be given for a price to be determined by return on HSBC fund on date so and so minus 10% annualized return as per the note plus adjustment factor. So this formula would be given in that promise to purchase as well. If the return on HSBC fund on date so and so is greater than 10% annualized return as per the note. This is the promise. The other things are clauses which explain or which would support this promise. It could be a one-pager, it could be two-page. Maximum, depending on which law firm is structuring this one, could be 3 pages. We call them undertakings. These undertakings, they are not very detailed documents, but its existence in the structure note is important for it to be binding. Similarly, promise to sell given by note issuer. This would be a simple promise, which is I promise to sell an amount of commodity X to investor on date so and so for a price to be determined by this formula, notional plus adjustment factor, if the return on HSBC fund on date so and so is less than notional, where the notional is the initial investment made by investor. 3 things, they are important: investment agency, master Murabha agreement, and the promissory arrangements. When HSBC fund generates a return above that of the promised in note, the investor receives 10%. The previous table I shared with you, that was for the note issuer. In this case, this is the investor. Investor receives 10%. The note issuer calls upon the promise to purchase in that case. When HSBC fund generates a return within the band promised in note, then no promise is called upon. As I mentioned earlier, no commodity trades would take place. When HSBC fund generates a loss, in that case, the investor calls upon the promise to sell given by the note issuer. So all these things are mutually exclusive. If the situation is such that the note issuer has to call upon the promise, that would happen. If the situation is such that the investor will have to call upon the promise, that would happen. So these products, they're very sophisticated products. They are now being used in the market by, as I mentioned, all the Islamic banks of any significance. And of course, their proliferation to the corporate side is increasing, but these are not retail banking products. After this, in the last 20 minutes, we would say a few things about Islamic private equity funds, Islamic real estate funds, and Islamic hedge funds. Islamic private equity is part of the Islamic investment products, but this has not flourished as much as the industry observers wanted it to flourish. One very good example of not a fund, but an Islamic private equity firm is Fajr Capital. It is a Sharia compliant Islamic private equity firm based in DIFC, Dubai International Financial Center in Dubai, which has undertaken a lot of Islamic private equity deals. Islamic private equity is considered closest to the spirit of Islamic financial principles of risk sharing and profit sharing. By its very nature, Islamic private equity, like private equity itself, would identify a distressed asset. By distressed asset, I mean a company. For example, if Fajr Capital finds that there is, I'm just using hypothetical example, a power generation company in Turkey is struggling. It is a public sector entity, and the government is facing a lot of deficit over the last 15 years or 20 years, Fajr Capital would look into this power generation plant and see whether we can improve this by bringing a change in management and, of course, by improving the efficiency. If they think that this is actually the case and the government is willing to privatize that power generation plant, Fajr Capital would buy it. Fajr Capital, as a private equity company, would not have long term interest in the asset. Rather, they would take a 10 years, 15 years view. So, during those 10, 15 years, they would then improve the efficiency and productivity of the company and would take its return from, say, 3% or 0%. Maybe it was a loss making unit at that time, to certain 15%, 20%. And at that time, it would sell either through an IPO or to another buyer and would get its return, which it has brought in by increasing the value of this asset. A good example, which actually was taken up by Fajr Capital in the realm of private equity, was its investment, its purchase of about 40% equity in Bank Islam Brunei Darussalam. This was a very innovative deal. The government of Brunei, through one of its vehicles, Brunei Investment Authority, invested in Fajr Capital, and Fajr Capital used part of that money to buy 40% equity in Bank Islam Brunei Darussalam, and with that one, the rights of management as well. So the bank at that time was not performing that well. Instead of the government looking into Bank Islam Brunei Darussalam directly and in improving its performance, they actually went to Fajr Capital, invested in one of their funds, and that money was then used to buy 40% equity in Bank Islam Brunei Darussalam for a period of about 10 years. The bank was managed by Fajr Capital. So the CEO of the bank was appointed, was Mubashir Kokar. So he actually went to Brunei and he stayed there and he improved the performance of the bank. Just before COVID, the 40% equity of the bank, Islam Brunei Darussalam, was sold by Fajr Capital to the government, and it received about 35% return, which was very good return. So this is what we mean by Islamic private equity funds. These funds are set up to identify Sharia compliant assets. So these are called Islamic because only Islamic assets can be bought and sold. And of course, the investors in Islamic private equity funds, they can benefit only from Sharia compliant activities. Islamic real estate funds. This is another example of alternative investment products. There are a lot of Islamic REITs now being offered, and some of them they are doing well. Real estate is a very well-known asset class amongst the Arabs and Muslims in general. Okay, they would know real estate a lot better than other sophisticated products. Hence, Islamic real estate funds, they are increasingly coming up in the market, and there is an improvement in appetite for these sophisticated vehicles like REITs. Previously, Islamic investors would be investing in the real estate directly, having exposure to the buildings and the assets, etc. Now, because of the REITs, they invest in the listed real estate companies in their stocks, and some companies they would have portfolios of these listed real estate company stocks in which the investors would invest. The screening process for the Islamic REITs is more or less the same as in case of Islamic equity funds. The only difference is that the portfolio would have the real estate companies stocks rather than general stocks or tech stocks and pharmaceuticals, etc. REITs, they would have these stocks of the companies which principally and primarily are real estate companies. And real estate companies, by and large, or real estate developers and companies, they're by and large Sharia compliant. I use by and large because there are certain aspects which must be looked into. If there is a real estate company which is into commercial buildings, and if it rents out the commercial buildings to banks, for example, interest based banks, that is not a Sharia compliant activity. And if this is a shopping mall where there are some restaurants and pubs serving alcohol, that is not a Sharia compliant activity. If there are certain outlets where lottery is being sold, or there are some mini casinos, that kind of tenants are there, these activities must be excluded. In case of REITs, the rule is the same, that 5% income, 5% rental income coming from this impermissible activity or these impermissible activities is tolerated. If it's beyond that one, then that real estate company cannot be included in an Islamic REIT. So this is important. Otherwise, the other ratios, liquidity ratio, receivables, etc., they must be observed as per the equity funds. The last thing which I want to highlight is the Islamic hedge funds. Islamic hedge funds received a lot of focus towards the end of the first decade of this century. Until the global financial crisis, there was a lot of emphasis on creating Islamic hedge funds. Hedge funds have attracted very bad reputation, and this is why a lot of Muslims, they thought that hedge fund in itself is not a Sharia compliant vehicle, which is a myth. Hedge fund strategies are numerous, and they, some of them, they're very complicated. A simple hedge fund technology or hedge fund approach is long short approach, and these hedge funds, they invest in the stocks. Now, having plain vanilla equity funds where the fund manager is taking only long positions, this is fine as long as the Sharia screening methodologies are used and Sharia compliant stocks are included in the investment portfolio. Taking a short position, that was considered, and that is still considered by many as something which is not recognized in Sharia because of this one principle which says that you cannot sell something which you don't own. However, during that period, a couple of Islamic shorting techniques were developed, and three or maximum four Islamic hedge funds, they came into the market, and a couple of them started doing quite well, and then this GFC happened, and these Islamic hedge funds, they became casualty of that period. Since then, there is no attempt of which I am aware to set up an Islamic hedge fund. But I believe that now this is the time for someone to relook into setting up some Islamic hedge funds as well, because that would bring the required sophistication in the Islamic finance industry to increase its width and depth. The last thing which I wanted to emphasize upon was the Sharia screening methodologies. I alluded to this point that market capitalization is not a very good indicator, and hence we should avoid using market capitalization as denominator for the financial screens used in the Islamic equity funds. Securities Commission Malaysia and some other index providers, they have now started preferring total assets as the denominator. And this is an approach taken by Malaysia. Almost all the Islamic equity funds in Malaysia have debt divided by total assets. This is an important consideration for those who would like to have stable Sharia screening methodologies. And this is more realistic as compared to market cap, which in many cases is driven by market sentiments. If someone wants to use the equity as the denominator, then my recommendation would be to use the book value only. Book value, this is a stable
figure like total assets. And this would allow an Islamic equity fund managers to manage their portfolio with a lot of certainty. This is something I wanted to highlight towards the end. This is not a major focus of this session number 3. We might come to this point later on in one of the forthcoming sessions. But because we refer to Islamic investments in this session, I deemed it important to highlight that total assets approach probably would be a better approach as compared to market cap.